All right, let's talk about a financial metric that is absolutely everywhere. You hear it on earnings calls. You see it in headlines about huge acquisitions. It's a big deal. But here's the thing. Just because it's everywhere doesn't mean it's understood. Or, for that matter, even trusted. So today, we're putting Wall Street's most controversial metric, EBITDA, right under the microscope.
And we're going to kick things off with a real bombshell from the late, great investor Charlie Munger. I mean, he really didn't pull any punches, did he? This quote just perfectly sets the stage for what we're digging into. How can one metric be so widely used by everyone and at the same time so viciously attacked by some of the smartest investors on the planet?
Okay, so before we dive into the controversy, let's just make sure we're all on the same page. What is EBITDA? Well, it stands for earnings before interest, taxes, depreciation, and amortization. Depreciation is for the wear and tear on physical stuff, like machines, and amortization is for intangible stuff, like patents. The whole idea, on the surface, is to get a pure look at a company's operating performance by stripping out all those other things.
But how did EBITDA get to be such a huge deal in finance? I mean, it wasn't always the star of the show. To understand the problems, you gotta understand where it came from. So let's get into its origin story.
So believe it or not, before the 1980s, people mostly looked at something called EBIT, which is just operating income. But then came the wild era of leveraged buyouts, or LBOs. The dealmakers needed a quick and dirty way to figure out if a company they were targeting could pay the interest on a mountain of new debt. EBITDA was perfect for that one. Very specific job. It showed a bigger pile of earnings available to make those interest payments. The problem? It escaped the lab. What started as a niche tool for LBOs is now used for everything, and people just casually throw it around as if it's the same thing as cash flow. As we're about to see, it's definitely not.
And that brings us right back to Munger's very blunt take on things. The case against EBITDA is, well, it's pretty powerful, and its biggest critics are investors who are absolutely obsessed with the actual real cash a business makes.
And here's Charlie Munger's legendary partner, Warren Buffett, with his own razor-sharp take. This one question gets to the absolute heart of the problem with EBITDA. See, it conveniently ignores depreciation and amortization, but those aren't just numbers on a spreadsheet. They represent the very real, very expensive cost of keeping a business running. That tooth fairy isn't buying new factories, new computers, or new delivery trucks. The company is, and it's paying with cold, hard cash.
Now, what's really brilliant is how Buffett frames this whole problem. He calls depreciation reverse float. This is such a key insight, and it really explains why just ignoring it is so incredibly dangerous.
So let's break that down. Good float is what an insurance company has. You pay them your premium so they get your cash up front. They only have to pay out claims later. In the meantime, they can invest your money and make more money. It's fantastic. But depreciation? That's reverse float. It's the exact opposite. The company spent a ton of cash on a building or a machine years ago. The depreciation charge you see today is just the accounting world slowly catching up to cash that's already out the door. It's a horrible kind of expense, and EBITDA just pretends it never happened.
And look, it isn't just Buffett and Munger yelling about this. Big, serious credit rating agencies like Moody's have laid out the case in black and white. This list here just hits some of the highlights. EBITDA completely ignores working capital. It tells you nothing about whether the earnings are real or just accounting fiction. And the big one, it ignores the money you have to reinvest just to stay in business. This is especially deadly for companies where stuff wears out fast, like tech or trucking companies.
Okay, so this isn't just some academic debate for accountants. Using EBITDA can literally hide the fact that a business is rotting from the inside out. It actively masks reality.
This is where it all becomes crystal clear. Check out the simple example inspired by another investing legend, Seth Klarman. You've got two companies. If you just look at EBITDA, you'd say, hey, they're identical. Both made $20 million. But are they really the same? Not even close. Company X is probably a software company with almost no physical assets. That $20 million is pretty much all cash in the bank. But Company Y is a heavy manufacturing business. It has to spend that entire $20 million every year just to replace its old, worn-out equipment. Its actual spendable cash profit is zero, a big fat zero. EBITDA makes these two completely different businesses look exactly the same. That's the illusion.
And this illusion has led to some spectacular failures. You can look back at trucking companies that were reporting positive EBITDA, borrowing money based on it, and then suddenly went bankrupt. How? Because while the income statement looked okay, in the real world, they couldn't afford to buy new trucks to replace their aging fleet. The wheels were literally falling off the business, and EBITDA hid that fact until it was way too late.
So after hearing all this, you might be thinking,
Great. The metric is a mess. But it brings us to a really simple, really powerful way you can protect yourself. How do you cut through all the noise and avoid falling into the EBITDA trap?
It all comes down to asking this one question. Every single time you see a company bragging about its EBITDA, your next thought, your immediate question has to be, okay, but what are the real capital expenditures? What do they actually have to spend just to keep the lights on and stay in the same place? That question is the key. It forces you to look past the accounting fiction and find the real cash truth of the business. It's the question that separates the money printers from the companies that are just running on a treadmill.
And that difference, the one between accounting stories and cash reality, is everything. It can be the difference between a great investment and a total disaster. Speaking of which, I have to say, this is not financial advice.